Hi everyone, welcome back. Today let's talk about risk management. Effective Forex risk management allows Forex traders to minimize losses while trading. With the risk management controlled, we can make consistent profits with low win rate. I'll show how the whole picture. Please subscribe and stay close to my weekly classes. I will share important trading tips and how to trade Forex successfully from beginner to advanced. Risk management is one of the most important topics you will ever read about trading. Why is it important? Well, we're in the business of making money, and in order to make money, we have to learn how to manage risks for the potential losses. Ironically, this is one of the most overlooked areas in trading. Many Forex traders are just anxious to get right into the trading with no regard of their total account size. They simply determine how much they can stomach to lose in a single trade and hit the trade button. There's a term for this type of investing. It's called gambling. When you trade without risk management rules, you are in fact gambling. Have you heard of the house always wins? The truth is that the casinos are just very rich statisticians, and they know that in the long run they will be the one making money, not the gamblers. Even if you win 100,000 jackpot in a slot machine, the casinos know that there will be hundreds of other gamblers who won't win that jackpot, and the money will go right back into their pockets. This is a classic example of how statisticians make money over gamblers. Even though both lose money, the statisticians or casino in this case knows how to control its losses. Essentially, this is how risk management works. If you learn how to control your losses, you will have a chance at being profitable. In the end, Forex trading is a number game, meaning you have to tilt every little factor in your favor as much as you can. In casinos, the house age is sometimes only 5% above of that player, but that 5% is the difference between a winner and being a loser. You want to be the rich statisticians and not the gambler, because in the long run you want to always be the winners. So how do you become this rich statistician instead of a loser? It takes money to make money. You need trading capital. The answer largely depends on how you are going to approach your new startup business. Let me show you how the system looks like, and I have made a table for the risk per trade. You may choose to risk how many percentage for each of your trade execution. This is the example, and when you have the trading capital of, let's say, 1,000 and risk 1%, which means your amount risk is $10. If you risk a 2%, amount risk is $20. If you risk a 5%, amount risk is $50. So this seems to be a small amount, but if you are taking the trade, we have 5 days a week. So the first week, if you are losing the trade of 20, let's say the 2% risk 20, and 1 week you have lose your 100. So if for 1 month you have lose 400 if you don't have the proper technical analysis or the proper risk management, so you will lose half of your money of your trading capital. If you are a day trader, conservatively you may be having 2 trades per day, so you will be risking $20 for your trades. This may sound small amount, but if you haven't managed your trading skills, you may lose half of your trading capital just in 1 month. Let me show you one example of how to set a risk reward. So this is the trade setup I would like to do for a buy limit. And I need to set a stop loss here. The stop loss, can see that the pip size is about 300 pips. So that means I'm risking this 300 pips. If I'm buying $1, it would be risking $300. So take profit. You can choose to 1 to 1, which is about 300, which means you risk 1 to 1. If you are risking 1 to 2, this would be another 600 pips up to here. If you are risking 1 to 3, you may set it to about 900. So this is what we mean by risk rewards. This is what we risk, this is what we take profit. We may choose the TP1, TP2 or TP3. So let's see that the price is triggered. It has reached 1 to 1, 1 to 2, and 1 to 3. So it's what means by the risk reward, and what you mean by how to choose 1 to 1, 1 to 2, and 1 to 3. I'm now showing you the differences of the 50% win rate and the 30% win rate. So let's go through the 50% win rate. You can see that the risk reward 1 to 1, 1 to 2, 1 to 3. And for example, you are risking at 1%. This is the number of trade, 1 to 10, and 50% win rate means that in 10 trade we are losing 5 trade, we are winning 5 trades. So when I'm winning 1 trade, I will earn 10, and when I'm losing 1 trade, I will lose 10. So if 50%, I will be break even. So in the risk reward is 1 to 2, so when I win, I will get 20, and when I lose, I will lose only 10, so I will have a profit of 50 if I have the 50% win rate. So if I'm doing risk reward 1 to 3, I am earning 100 profit with the $30 win and the $10 lose. I just want to show you all that even with the low win rate, you still can make profit with the proper risk management. Consequently, having a proper forex risk management plan in place can make for safer, more controlled, and less stressful forex trading. So this is the methodology of having earning consistency in forex. In forex trading, technical is only 30% and psychology is 70%, which include the risk management. So if you know that method, you can make profit in the long run with lower win rate. That's all for today, and I'll hope to see you all in next classes.